Dear students, welcome to our channel. In this video, let us have a discussion about ratio analysis. Ratio analysis is an financial tool applied to analyze the financial statements to understand the financial performance of an organization. Financial statements. Firstly, profit and loss account. This statement gives the business results of a company for a particular financial year, whether the company has gained a profit or incurred some loss. Balance sheet. This financial statement provides the financial status of a company, what are all their asset holdings and what are all the financial commitments, that is the liabilities. Cash flow statement. It details about the cash inflow and cash outflow during a year. Normally, the cash flow is categorized into operating activity, investing activity and financing activity. Understanding the financial statements. Who is interested in this financial statement and what they want to understand? It can be broadly classified into internal people of an organization and external people of an organization. Starting with internal, firstly the company owners. Their priority is wealth maximization. The company owners want to assess the growth and stability of the business. They want to turn up their billion-dollar company into a trillion-dollar company, and they will calculate the return on investments for the business ventures. They are the vision setters for their organization. Following the instructions of the owners, the management will trigger the profit maximization. The management will make an risk and return analysis of the various business ventures. They plan on the operations and control over the activities. They make some strategic decisions like increasing the product demand, how to handle the competitors, and analyzing the financial viability of the various business projects. And the management want to make their company as an industry benchmark. Following the management, the employees of the organization, they are concerned about their compensation factors. They gauge the financial well-being of a company and thereby connect their compensation aspects, that is the salary paid to them, the bonus what they get, the allowances and the perquisites factors. And following the internal users, the external people, who are all the external people interested in understanding the financial statements. Firstly, the investors. Investors prioritize the trustworthiness. They want to understand how far a company can be trusted for their investment. As an investor, if I invest the shares in a company, I look upon the capital security, what extent my money will be secured. As long as I continue as a shareholder of a company, what is the holding period return that I will get? Then capital appreciation. When will my investment double or triple? That is capital appreciation. The next expectation is what is the return on investments? I invest some money, whether it is growing at 10% or 25%, what is the return on investments that I get in an investment decision? Banks and financial institutions, they extend the financial support to the company. They are concerned about the credit worthiness and they want to know the debt repaying capacity of the companies. For that, they will understand the liquidity power by making some analysis. One such analysis is the ratio analysis. The creditors, they look into the profitability and turnover aspects of a company because they support the company's functions by providing the raw materials on credit. Government authorities, they are concerned about the financial aspects and the tax regulations aspect, how far the company is prompt in paying the taxes, and they assure the financial stability of the company to the common people. Some of the government agencies like SEBI, CAG, RBI, National Company Law Tribunal do the work of understanding the financial stability and thereby passing on the information to the common people. So, in putting together the internal and external peoples analyze the financial performance and come to a conclusion about a company, that whether it is a declining company or a constant company or a growing company. For all these analysis and understanding, ratio analysis is one of the tool applied over the financial statement. It is applied to compare the various aspects in the financial statement. Ratio analysis is a simple mathematical calculation fixing something in the numerator and something in the denominator. Now what to fix in the numerator and what to fix in the denominator? The various parties concerned like owners, management, investors and creditors would like to compare the various components of the financial statements like cash, purchases, sales, building, machinery, reserves, debt content. They compare and understand the financial performance of a company. Now, ratio analysis. Classifying the ratio analysis, it could be broadly divided into 4 categories. Liquidity ratio, solvency ratio, turnover ratio and profitability ratio. Liquidity ratio. This ratio is applied to understand the short-term financial stability of a company. What extent the company could be able to meet their debt obligations in short run, say within a period of 1 year, and how far the company is capable of managing the day-to-day business operations. Liquidity ratios are, the concern about these ratios are payment for purchases, that is for the creditors, payment of interest and dividend to the bankers, financial institutions and shareholders, other regular payments like wages, taxes, insurance premium, license renewal aspects. These are concerned in the liquidity ratio. Now this liquidity ratio has further some few broader categories. First one is current ratio. Current ratio is current assets divided by current liability. Now what are all current assets? Now that assets which could be easily convertible into cash could be termed as current assets. For example, stock. You have a stock of goods in your company. You want to convert it into cash. Announce a discount, their sales is triggered and you get the cash. Then receivables, you get so much of checks, discount it with the bank, you can convert it into cash. Debtors, you made the sales, you made a credit sales, you announce a discount to the debtors and immediately the settlement will be made. Current liabilities, that financial obligations that are to be settled immediately. The short-term borrowings, the trade payables who have supplied the material to you and the company has to pay to them. They are trade payables. The bank overdraft, short-term provisions, these constitute the current liabilities. So current ratio measures the financial soundness of the business in the short-term duration. The ideal current ratio for any company is 2:1. If the current ratio is greater than 1, we can understand that the company is financially doing well and the suppliers, bankers, money lenders would be ready to extend the financial support. In case if the current ratio is just equal to 1, the performance, financial performance is average and the suppliers either delay or reduce the financial claim that you make to them. If the current ratio is less than 1, then the financial performance is very low and the bankers or the money lenders may deny or even refuse to extend the financial support to a company. The next category of liquidity ratio is the quick ratio. When current ratio speaks about 1 year duration, quick ratio is less than that duration. That is say for a duration of 3 months to 6 months. Now quick ratio is liquid assets divided by the liquid liabilities. Liquid assets could be arrived by current assets, deducting inventory and prepaid expenses from it. And liquid liabilities are current liabilities minus bank overdraft. For any company, the quick ratio, ideal quick ratio is 1:1. The quick ratio could also be termed as asset test ratio or liquid ratio. Then third category of liquidity ratio is the cash ratio. Cash ratio is equal to cash plus cash equivalents divided by current liability, where cash are ready cash available in the company, the checks and the bonds are cash equivalent. And when cash ratio is more, so your bargaining power is high, you can make an immediate settlement on purchases. So you can expect the discounts from the supplier. When cash ratio is equal to 1, you are meeting you are just sufficient to pay the expenses. You can just maintain the status quo of the business operations. In case the cash ratio is less than 1, the funds are not sufficient to meet out the business operations, and you should seek for the financial support from the other sources. So classification of ratios, the first category is liquidity ratio. In that current ratio, quick ratio, cash ratio are some common terms. The next category is solvency ratio, turnover ratio, profitability ratio, which would be discussed in our ratio analysis part 2. Okay friends, your like, support, comment and subscription to the channel may encourage me to post more such videos. Thanks for watching.